I'm very aware that I am keeping you between you and your lunch, so I will keep this brief. But I just wanted to run through some of the CV trends we're seeing through the data that we gather here at GCV, a bit of a look at the state of corporate venturing as it is in 2026. So yeah, I'm Joe. I'm the head of data and AI here at GCV. The data that we work with at GCV comes primarily from two sources, both of which are brought together in our flagship report, The World of Corporate Venturing, which is an annual look at an annual definitive guide to the industry, a view of the state of CVC each year. And that comes from two places. It comes from our benchmarking survey of around 400 CVC units, which spans industries, geographies, investment mandates, and maturity stages. And it very intentionally includes both long-established market leaders as well as newer programs to give us as complete a view of the industry as possible. And it also comes from our CVC funding round database, which has over a decade of tracked CVC-backed investment rounds and units gathered through various data feeds and a daily comprehensive scan of news reporting around investment. So this has been mentioned a few times in a few different sessions here, including the one that was just sat through. But last year was a record year for CVC. For the first time ever, we tracked over 3,000 active corporate investors in our funding round database. It was questioned a little bit what that meant in the panel. What we mean is we've seen over 3,000 corporates make at least one investment in the last year. And this is reflected also in a rise in CVC-backed rounds. So the number of corporate investment rounds rose to over 5,000 last year, to 30% increase year on year, and that brought it close to the pandemic era peak we saw in 2021-22. As we've seen overall investment rounds then drop off, but the number of CVC rounds increase, that means that almost 1 in 5 investment rounds now has some form of corporate backing. And the picture's a lot more stark then if we look at the value of those rounds. If we take the rounds and we look at them in dollar value, over half of rounds in dollar value now have corporate backing or did last year. And again, that's driven by a significant increase in the value of those rounds, up 75% between 2024 and 2025. If we then bring that forward to look at the start of this year, bring it really up to date. Across the first 5 months of this year, we saw that trend really accelerate. We've seen nearly $370 billion in corporate-backed investment rounds in the first 5 months of 2026, which is 60% higher than in the whole of 2025. I assume I'm not telling anyone anything they don't know, but that's really been driven by the large later stage rounds in AI companies. We've seen over $260 billion in corporate-backed investment in AI in the first 5 months of this year. That's triple what we saw in AI in the whole of last year and more than across all sectors last year. And overall, what that means is that AI now represents over 70% of the corporate-backed rounds that we see in value, which is interesting for us in two respects. One, in that it drives those headline figures, the big leaps in the value of those investments, but also in the way we track data. If AI is such a dominant part of all investment in this way, whether we can stop to consider these companies as AI companies and start to categorize them more by what they do than how they're doing it and the tools they're using to get there. I'm going to move on to a second part of the talk, though, because while they're the headline figures, what that sort of masks and what we can see through our benchmarking survey is how different that is to the majority of CVC. So while it's those very large investments that skew the figures when we're looking at the overall trends, if we look at what we get back when we ask CVC units what they are focusing on, it's a very different picture. There's a real focus there on early stage rounds. Over half of CVC units in our survey had a focus on seed rounds and nearly all on early stage rounds A and B investments. And that's reflected as well in what they say their priorities are. This chart tells us their CVC program charter, and what it tells us is that most CVC units have more of a focus on preparing for future disruptions, so that's new technology and innovation, than it does across any of the other categories, supporting existing business, new business, or financial returns. And again, this comes back and we see this reflected in the data. The value of investments really rises because of the later stage big value investments. But if we look across all corporate-backed rounds, over 85% of corporate-backed rounds are still in those early stages, seed A and B, and more than 80% of corporate-backed rounds have a value of $50 million or less. The survey shows us, obviously, why this is. It's because of the value of those funds. So the reality of most CVC funds is they're a lot smaller than those big value investments would suggest. The chart on the left here tells us that a third of CVC funds are managing a fund size under $50 million, two-thirds under $200 million. And the chart on the right shows us that over 75% of funds have total assets under management of under $300 million. Final point, really, from our survey is what those CVCs are doing with those funds. They're becoming more sophisticated in the way they operate and sort of branching out the way they operate. So over 90% of CVC units now take board and/or observer seats in their portfolio companies. Nearly a quarter are actively engaged in sales on the secondary market. But what we've also seen in recent years is a focus where over 50% of CVC units are now taking LP positions in other VC funds. So I'm going to try and tie that together a bit. What we're sort of seeing from our data now is two different sides to CVC. We see the overall value of the sector and the headlines really dominated by big later stage deals in AI. In the first half of this year, we've seen the 5 biggest CVC backed rounds we've ever recorded in these companies. But the reality that what we get from the survey is most funds are much smaller, focusing on earlier innovation rounds. And in doing so, they're really maximizing their resources and becoming more sophisticated in their approach. I've gone quite quickly there because it's lunchtime, but yeah, we have a lot more benchmarking reports, market data, all sorts of things on our website, and I believe as attendees here, you get access to that for a few weeks, month, I'm going to say a month. So do go and explore that, but we're also always really keen to work with CVCs to cover any gaps in our data, anything you think we could be exploring that we're not so far. So my contact details are there as well. Other than that, I'm going to leave you to enjoy your food. Thank you.
Thank you, Joe.